Hi everyone, good morning. Today we are going to discuss the leverage buyout advanced question and answers. This is in continuation to the previous series. This is episode 33 and my name is Deepak Bist. Let's get started. So question number 4 is about why might a private equity firm allot some of the company's new equity in LBO to a management option pool, and how would this affect the model? And basically, what they are asking is why give managers some ownership in an LBO? So imagine a private equity firm buys a company and they want the managers, the people who are actually running the company, to work really, really hard to improve so that the private equity firm can sell it off later for a profit. And one of the best way to motivate people is to give them a chance to share in the upside. So the private equity firm says that if the company does well and we sell it off for higher price, you also get a piece of the profit. And they do this by giving managers stock options or employees, which are like lottery tickets that only pays off if the company becomes more valuable. So this pool of potential shares is called management option pools. And how does it affect the model? So when the company is eventually sold, the model calculates the price per share at the time of the sale. It figures out how many shares management get from these of their options, and the money from the sale is then split between the private equity firm and the management team, and based on their options. And because of some of the profit goes to the management, the private equity firm shares a little smaller. The private equity firm's share is actually a little smaller, but not that much big. That's going to be, the employees and the management are going to get a very small portion. But the idea here is that the happier and the more motivated the managers are, so the better the company will perform. And if the company performs better, so it will sell out at a higher price and everyone will win. And if we think about it from an practical perspective, so when a private equity firm buys a company, one of their biggest priorities is to keep the management team motivated. So there are people who actually run the business day to day, and so they are central to improving the company's process because they are actually running the business. And to encourage that, the private equity firm often sets up what's called a management option pool. And in simple terms, it's a collection of stock options that management can earn if the company performs well. So the idea is similar to a bonus system, but instead of paying cash, the reward comes in the form of ownership. And this aligns everyone's incentive. And if the company grows in value and the private equity firm eventually sell it for a higher price, the management team shares that upside. So they think and act like owners, not just employees. And for modeling perspective, when we talk about the modeling perspective of an LBO, uh, so this impacts the final return also. So when the private equity firm exits the investment, the model has to calculate the eventual price per share. And so then we determine how many shares management get through their options, and usually using something called the treasury stock method. And because management is taking a slice of the equity at the exit, the private equity firm share, and therefore their return is slightly diluted, not heavily, but very slightly. But the dilution is intentional actually. So the expectation is that the motivated management, uh, the more the motivated the management, the more the better the company performs and grows faster and ultimately sells for a higher price. And afterwards, the internal rate of return or the returns actually increases. And modeling considerations, yes, you need to include the option pool as a line item in the equity schedule. And dilution must be considered when calculating the equity IRR for the private equity firm. So your denominator, actually, your dilution impacts your denominator. So That should be considered. And if management options are tied to the performance milestone, the model may include scenario analysis to show different levels of option exercises and corresponding PE firms return. So, in summary, just understanding the purpose is to incentivize management to stay and maximize to incentivize management to stay and maximize performance. The mechanical aspect is that we allocate a portion of new equity as options. I use the treasury stock method to calculate dilutive effect at exit. There is going to be impact on the model, and there are also strategic benefits. So the impact on the model is that it reduces PE firms ownership and the IRR slightly, but increases likelihood of hitting performance targets. And the strategic benefit is that the alignment of management and investors' interest, which often drives higher total value. So this was actually a very good question, and you need to think deeply to understand and to answer these kind of questions. And previously also I've said that these are advanced questions. And for entry level jobs or entry level at entry level, these questions will not be asked to you. So let's move to question number five now. So question number five is about why would you use PIK? So the payment in kind debt rather than other types of debt, and how does it affect the debt schedule and the other statements? So payment in kind. So imagine what is, so first let's talk about what is PIK debt and why would a company use it? So imagine you borrow money from someone, but instead of paying the interest in cash every month, you are allowed to just add the interest onto the amount you owe. Think about it. So you are not paying the interest in cash every month, but you are allowed to just add the interest onto the amount you owe. So the debt keeps getting bigger over time, but you do not have to pay anything right now. So basically, that's payment in kind. So it's a PI or we say PIK debt. So why would a company want this? The PIK debt is helpful when a company does not have much cash right now, but expects to have more cash later and needs money urgently, like in leverage buyout. So it's like saying, I cannot afford the payments today, but I will pay you back later with extra. And because it's riskier for the lenders, payment in kind usually comes with higher interest rate. So I hope this is clear, but how does PIK debt affects the financial model? So now the question is, how would it affect the financial model? So see, so there is going to be a debt schedule. First, we need to discuss about the debt schedule. And for normal debt, you actually pay the interest on cash and debt balances because it stays the same unless you repay something. For PIK in payment in kind debt, you do not pay interest on cash. So instead, the interest is added on the loan balance. So the loan grows every year. Impact on debt schedule. And the impact on income statement is that you still record the interest expense because you owe it, but it does not use cash. So you do not use cash to pay the interest expense. You record, but you still record the interest expense on your income statement. And on the cash flow, you add back the PIK interest because no cash actually left the company. So you need to understand that. We are just adding this interest onto our debt. So our debt portion is increasing, but we are still processing the interest portion in our income statement. And on the balance sheet, the debt principal increases over time due to the accrued PIK interest. And equity is affected initially, but higher debt will increase leverage and interest expense in the future, which indirectly affects retained earnings. So, in simple terms, PIK debt lets the company conserve cash now and worry about paying later. And it's more expensive and riskier. So, lenders charge more interest. And in the model, the debt keeps growing because the interest gets added to it. And it actually reduces the profit also, but does not reduce cash because it's non-cash expense. To just understand this thing, so PIK, we are just adding our interest onto our debt, and this is new. And I, because previously when we were discussing about the types of debt, we have discussed about PIK, but this is the new aspect, all new aspect, and PIK. The treatment of PIK on the balance sheet, income statement, and cash flow statement, we will discuss about it later on when we will discuss about the types of debt in a company, and when we will be doing a leverage buyout or any valuation model. So I will try to incorporate PIK debt also in the model. And if you want to learn more about these kind of things, the fixed income portion, because leverage buyout is more oriented towards debt portion. So you can study about the fixed income markets, and there these are the common terms in fixed income markets. So let's move to question number 6 now. And okay, so let's discuss the key takeaways. The PIK debt is essentially a high cost. The cost is high because of the risk, high risk, yes. Flexible form of financing, and it's very flexible. It lets the company conserve cash. So they are saving the cash while the PE firms maximize leverage. They're increasing the debt, but it makes the company more leveraged over time, which increases financial risk. And in model, it behaves like a bullet debt with interest added to the principal and adjust for non-cash interest on the cash flow statement. So I hope this is clear. And all right, so let's move to question number 6 now. So question number 6 is about what are the some examples of inoccurrence covenant and maintenance covenant. So covenants, yes, covenants are just a fancy term for rules and regulations which comes along when you take debt from an institution. So what are covenants? So covenants are rules that lenders set when they give a company a loan. So lenders are actually setting the rules, and they are like conditions the company must follow so the lender feels safe. And there are two types of covenants: in occurrence covenant and maintenance covenants. So in occurrence covenants are the rules the company must follow only when it tries to do something big, like taking more debt or buying another company. But maintenance covenants are the rule the company must follow all the time, and often every quarter to prove it's financial healthy. So it's financially healthy. So maintenance covenants and in-occurrence covenants, there's a difference. Maintenance covenants are said to be more strict than in-occurrence covenants. So in maintenance covenants, there are certain ratios that the company should manage, company should maintain also. And if the company breaches any of those covenants, then there are actions which are taken by the lenders. So, covenants are actually in favor of the lenders majorly. So let's discuss about in-occurrence covenants. So in-occurrence covenants are basically those covenants which are triggered by big actions like taking more debt or buying another company. So think of these rules like a parent giving a teenager um, when they want to do something extra. So if uh, whether you can borrow the car only if you fill the tank, these kind of situations. So in finance, in-occurrence covenants works the same way. They apply only when the company tries to take an action. For example, you cannot borrow more than $2 billion in total. So the company cannot take too much new debt. If the company sells something valuable, you must use the money to repay debt first. So this prevents the company from wasting cash from big asset sales. Um, Third point would be that you cannot buy another company if the price is over $200 million. So these kind of covenants, these kind of situations where the company wants to do something big. Annual capital expenditure cannot exceed more than $100 million. So annual capital expenditure cannot exceed more than $100 means, if you are familiar with the capital expenditure term. So capital expenditure is done when the company is actually into expansion, and this actually increases your assets. Capital expenditure, the more the capital expenditure does, the company, the more its assets actually increase. And if you are having assets, I mean, you have invested way too much in assets and you are not generating that much in proportion net income. So your return on investment and the other metrics get messed up. So this is something that if you have enough assets, then you try to generate more using those assets. Don't overinvest. And these kind of examples come into play when we are talking about inner current covenants. So these are actually some sorts of restrictions, and typically tied to new debt or certain transactions. And when we talk about maintenance covenants, so maintenance covenants, these are like regular doctor checkups. So even if the company does something new, or nothing does nothing new. So this actually it must prove its financial health every quarter. So how much debt the company has, or how much the money the company is earning. So these kind of ratios are majorly seen in maintenance covenants. So these require the company to maintain certain financial metrics all the time, typically measured quarterly or semi-annually. Total debt to EBITDA ratio, senior debt to EBITDA ratio, EBITDA to interest expense should be greater than 5%. It's favorable for the lenders. This means EBITDA must be bigger and interest expense should be lower. Here it means debt should be, so they want debt to be less and EBITDA to be bigger. So that's why they are saying less than 3%, less than 3x. And this can also, less than scenarios can also only happen when your denominator is bigger and the debt is, or your numerator is smaller. So what they are here, they are in the less than figures. They are asking less than figures, which are in favorable to the lenders. They are asking, so the debt should be low and EBITDA should be big. Senior debt should be low and EBITDA should be big. EBITDA should be big and interest expense should be low. So this, in this case, it can, the lesser the interest expense, the more multiple it will generate. So EBITDA minus capital expenditure and divided by interest expense. This is in favor. So this means that EBITDA minus capital expenditure should, the numerator number should be bigger than the interest expense. So bigger the interest expense, the smaller the interest expense, so the multiple will increase. And the key idea here is that maintenance covenants ensure the company stay healthy and does not get too close to running out of money. And in short, inoccurrence covenants trigger only when the company tries to do something big, borrow, buy, sell, expand, or spend. So you cannot borrow more than this amount. So that's incurrence covenant. And maintenance covenants are financial checkups that happen every now and then or regularly. And examples are, you must earn enough to cover the interest payments. Why does it matter in LBOs? So maintenance covenants actually limit the financial flexibility, but they are cheaper debt. And incurrence covenants allow the freedom, but they are usually higher cost debts. And a private equity firm will balance the two depending on the company's cash flow stability and growth plans. So I hope this was pretty much it to absorb for today. So I'm trying to make smaller videos so that we talk about the sessions in detail. And if you have any doubts, kindly post a comment and I will be happy to answer. Right. Thank you. Thank you for attending the lecture.